All right, thank you very much. In this video, I want to teach you how to link the three fundamental financial statements together. For you to be a model of finance and accounting, there's one fundamental thing that you need to know. For you to be a consultant, you need to understand the three fundamental financial statements. They are key to finance, they are key to the decision making. There are several accounts that can be prepared: amortization schedule, depreciation schedule, capex schedule, statement of equity, debt repayment schedule. All of that all have a role to play in preparing a final account. The three final accounts are statement of financial position, statement of cash flow, and statement of comprehensive income. So without wasting much time, I zoom in into my Excel sheet. And here we go. Okay, this is a typical financial model. In preparing a financial model, first of all, you need to begin with what we call the assumptions. So in every budgeting process or every company, the company always at the beginning of the year through its board meetings set up some assumptions that will become the policy that drives the operations and activities of the business for the rest of the year. In actual sense, sometimes the board and management of the company can be futuristic and not only concerned about historical records, but want to also focus for the future. That in 4 years' time, where will the company be? In 3 years' time, where will the company be? So in preparing a model for the business, it will actually also take into account projections into the future. So this is typical finance model, income statement, so which is being projected for the next 4 years, year 1, year 2, year 3, and year 4. So with this, when you have the assumptions, so with the income statement, what we will be interested in will be the revenue. And where will our revenue come from? Our revenue come from our activities, our transactions with our customers, right? So this was the projection made. Then how do we get? We will have this number of clientele base or customers. How many orders would they make from us to enable us make profit? So we have the average order value. There are times there will be return of some goods and services. So call it refund, where you need to pay refund. There's time you need to give discount and all that. So basically, there are times you need all right. All right. We have continued. So I said you need the assumptions. So these are the assumptions that has been made to underpin the financial statement that we made. Here we go. And here is the financial statement. Yeah, right. Showing us the the project, the using the assumptions that underpin this model. So, all right. So you have the income statement year one, year two. So using the projection that underpin the budget, it gives us the following figures as shown. So we have the revenue, the gross revenue, then from there, refunds, discounts, net revenue, the cost of goods sold, products, fulfillment, and merchant services. So we get our total cost of goods sold, get our gross margin, revenue minus what? Or net revenue minus what? The cost of goods sold gives us the gross margin. So when we get our gross margins, we move to operational expenses. We take, we get our total OPEX, that's it, as this. Then to get our operating income, we simply, by subtracting the gross margins from the operational expenses, we get our operational income. So we have our interest payments. So if you don't want to know our interest payments, we come to the balance sheet. Yeah, okay. Our interest payments forecast is here. The balance sheet to have the interest rates as again the to multiply long-term debt by the interest rate, you get the interest expense, the interest payment this year. So we come to net income before taxes. You get this, your net income before taxes is simply operating income minus interest payment. What remain is your interest expense. Then you find the percentage of net your net income. It's simply the net income over your net revenue. Net income after taxes over the net revenue. That gives us the percentage of net income. And given, I must explain the gross margin. To get our gross margin, the gross margin over revenue. Gross margins is total net revenue on our total cost, the cost of goods sold. It gives us our gross margins. To get the gross margin percent, the gross margin percent tell us at which level is the company operating to make profit, and what percentage of operations does the company need to break even or make profit. So we take together, we take the gross margins over our net revenue, and that gives us the net percentage of gross margin. Now we come to the EBITDA. EBITDA is earning before interest, taxes, depreciation, and amortization. To get our EBITDA is simply our depreciation figure, our depreciation plus operating income. Depreciation plus operating income, because depreciation is not a fiscal movement of money. It's not a fiscal outflow of money. And that's why we're adding that back. And when you add that, to get our depreciation, come to the CAPEX channel, which I've prepared here. So these are the useful life, the number, and then these are the depreciations for the the cumulative depreciation for the various years. All right. So these are the accumulated for the various years which have been taken here to get, and here is the depreciation, which is under operational expenses. Because the value of the machines is also part of the production process. So once the value of the machines are reducing, that is why depreciation is an expense, and that's why it has been added here. So please let's take note of that. Now let's come to the balance sheet. Yeah, in preparing the balance sheet, you need something very vital, your cash flow statement. To get a cash flow statement is basically divided into three sections. We have the operating activities, investment activities, and financial activities. It's arranged. The final activity is only last. So when it comes to operating activities, operating activities simply refers to things that actually go into the operations of the business. And then the investment activities are the money the business invests in order to operate or make profit, in order to function as a business. So that's the investment activities. And then the financial activities are the money you raise, the money that you raise to help in running the business. It could be borrowings, repayment of debt, and all that. All those fall under. So when you do that, when you but to begin with, before you come to operating activities, you have to first of all look for your net income. The net income, which is in the income statement of comprehensive income, is here. Our net income is here. Net income is after you have taken taxes and other expenditures. You have taken all expenditures and you have taken taxes out. So what is remaining is the net income. And then to know the percentage of net income that you are making against your revenues, you take the net income over the revenue, the percentage which we have mentioned earlier. So you put your net income before you, you begin in terms of the cash flow statement. Cash flow statement is necessary according to international accounting standard IAS 7. It's very, very necessary because in the olden days you could do an analysis that shows that the company was having profit, but you go to the company, there's no money. Meanwhile, the books of the company is speaking to profit or prosperity. Meanwhile, it's a negative environment. It's a cash flow that actually tells us whether the profit the companies are declaring is translatable or is convertible into cash. So it's very, very relevant part of the forecast. So this is what it really tell us. So when we did that, we arrive at our net cash flow. The net cash flow is now telling us after the net cash flow is actually taking when you add the income, your operation money, then you take out your investment, the money that is left, then you add it to the finances, the money you raise and you spend, and then the payments you are making. When you get positive, it means the business has money. When you get a negative value, it means the business has made losses. So in this will tell us whether the profit that has been declared and the net income here are relevant or not. Like this net income, the cash statement that validate or invalidate this. The balance sheet is like a statement for the pineapple at a specific point in time. At the end of each year, the specific the state of the economy in terms of assets, liabilities, and equity. That is a statement pointing to a specific point in time. And basically, to before you can do your forecast, you need to have your historicals, a previous year, before you start the forecast. And in this instance, our forecast has already been given. The historicals are there, historical balance. So we come to forecast, we need a cash flow. So which we then we have to forecast. We forecast for deferred revenue. We forecast for account payable. We forecast for accumulated depreciation. We forecast for account payable, deferred payment, all that, and then the cash flow, the net cash flows. This what we bring. And to calculate your net cash flow is always your historical plus the cash flows, your historical balance from the cash plus the net cash flows that you have generated. So when you add that and you forecast, you'll be able to tell in a 4 year period what you will get to. So basically, ladies and gentlemen, this is a simple model, financial model I've done. If you like, subscribe this video, subscribe to my channel, like it and share. Bye bye from now. Bye bye.